The jobs report is not what it seems. It's painting a much darker picture than what you've been led to believe. After poring over the jobs data and reading the fine print, we're going to show you why there's really no foundation in the optimism we've seen in reaction to the jobs numbers. There are a number of sides to the story. What were the actual jobs numbers? What does this report and the data tell us about the economy? What's the risk in this data? This past Friday, the Bureau of Labor Statistics released their latest jobs report. This included the announcement of 303,000 new non farm payroll jobs that were created, and this was the cause of a great deal of excitement. Reuters reports Wall Street's main stock indexes rose on Friday after stronger than expected March jobs data pointed to resilience in the labor market, even as it meant the Federal Reserve would be in no rush to cut interest rates. From Zacks, hotter than expected non farm payrolls for March. And from Bloomberg, U.S. jobs roar again as payrolls jump 303,000. We're going to show you there's actually little reason to celebrate. The 303,000 figure did in fact occur, and it does mark an improvement from the prior month's 270. And this also coincides with a 3.8% unemployment rate, an improvement from last month's 3.9. But consider those individuals that hold multiple jobs. Of the 303,000 jobs created, 217 are for jobs for individuals that simultaneously hold multiple positions. In fact, the multiple job holders represent a significant percentage of the workforce. Currently, 5.2% of the workforce is comprised of multiple job holders, just below the yearly high of 5.3% achieved last December. These levels represent multi-year highs. A growing and significant percentage of the workforce is now comprised of multiple job holders, certainly not a step in the right direction. Now, there were a total of 303,000 new jobs created last month, but here's the riddle. What kind of jobs are we talking about? Let's now consider what we typically know as the standard full-time employment. Well, those full-time jobs actually declined by 6,000, while the 303,000 new jobs that were created were comprised of part-time or secondary jobs, and last month was not an isolated incident. In February, we lost 187,000 jobs. In January, a loss of 63,000, and last December, a decline of 1.5 million. Considering the job growth is occurring in those positions, other than standard full-time work, it is no surprise that earnings are also declining. Average hourly earnings on a year-over-year basis continue to decline, now only rising by 4.1%. We know there are many sides to the data. The decline in jobs is also apparent through other metrics. Last week's JOLTS report showed job openings near yearly lows, just above 8.7 million. Moreover, total separations are on the rise, now standing at 4-month highs around 5.5 million. What is the risk in this particular type of data? On the surface, the jobs market looks good. After all, there were 303,000 jobs created. Given the sticky inflation and resilient jobs market on the surface, the Fed has no reason to cut rates. But underneath, we can see the jobs market is changing. Full-time employment is morphing into part-time and secondary work. Eventually, if this trend continues, the deterioration in employment will become more evident. There's a reason we study these economic reports. Every employment number, every growth report or housing survey is considered by the Federal Reserve in their determination of monetary policy and interest rates. Interest rates affect every facet of our lives. Our decisions to invest in stocks, purchase a house, or even open a new credit card is ultimately influenced by interest rates. Our objective is to decipher each major economic report and illustrate the message behind the data. What does a figure tell us about the economy? How does it fit in with the Fed's plan? And what possible effects may we anticipate within the financial markets? The latest data regarding the jobs market is troubling to say the least. It's important that we make note of a change in the composition of employment, even if the data is still not compelling enough to influence the Fed. Here we also like to discuss lesser known measures of the economy, one such as credit spreads. We recently dove into the details of exactly how credit spreads work. I think you'll find it quite interesting.